What if I told you that one of the biggest retail giants in America didn't just decline? It practically vanished in slow motion, right in front of everyone. Think about the last time you walked into a Kmart store. Take a second. It's actually harder than it sounds, isn't it? For many people, that memory is either fuzzy or completely non-existent. And yet, there was a time when Kmart wasn't just relevant. It was everywhere. It was the place families relied on, the store people trusted, and for millions, it was the default choice. So how does a company go from dominating the retail world to becoming almost invisible? To understand that, we have to go back to when Kmart was at its peak, when a simple announcement could electrify an entire store. Attention Kmart shoppers. If you grew up in that era, you probably remember that phrase. It wasn't just an announcement, it was an event. It signaled something called the Blue Light Special, a limited time deal that would suddenly pop up in the store. A flashing blue light, a surprise discount, and customers rushing in from every aisle. It was unpredictable, exciting, and, most importantly, effective. People didn't just shop at Kmart. They lingered. They waited. They explored. That strategy did something powerful. It turned shopping into an experience. But Kmart's story didn't begin there. Long before the blue lights and crowded aisles, the foundation was laid by a man named Sebastian S. Kresge. In the late 1800s, he built a chain of stores that sold products for just 5 and 10 cents. Even for that time, those prices were incredibly low. The concept was simple: affordable goods for everyday people. And it worked. Fast forward to 1962, and the first official Kmart store opened its doors in Garden City, Michigan. That moment marked the beginning of something much bigger. The company expanded rapidly, riding a wave of suburban growth and consumer demand. By the late 1970s, Kmart wasn't just successful, it was dominating. In fact, it had become so central to the parent company's success that the entire organization was eventually renamed after it. Kmart wasn't just another retailer, it was the retailer. But here's where things get interesting. Success can sometimes hide problems. Through the 1980s and into the early 1990s, Kmart continued to grow. New store formats were introduced, bigger locations, more inventory, more reach. On paper, everything looked like progress. Behind the scenes, though, a different story was beginning to unfold. Instead of focusing purely on improving the shopping experience, Kmart started making aggressive business moves, acquiring other companies, expanding into new areas, and spreading its attention thin. It wasn't just running retail stores anymore. It was trying to become something much larger. And that shift came with consequences. By the early 2000s, cracks were starting to show. In 2002, Kmart filed for Chapter 11 bankruptcy. Now, this type of bankruptcy doesn't mean the company disappears. It means it's trying to reorganize and survive. But even that move hinted at something deeper. The problems weren't temporary. They were structural. Not long after, Kmart became involved in a merger with another struggling retail giant, Sears. Interestingly, while it may sound like Sears took over Kmart, the reality was the opposite. Kmart actually acquired Sears. Yet, the combined company kept the Sears name, forming what became known as Sears Holdings. That alone says a lot. Two of the biggest retailers in the United States had joined forces, not from a position of strength, but from a need to survive. And here's the part that should raise eyebrows. Just a decade earlier, a merger like that would have been almost unthinkable. These companies were once too powerful, too dominant to combine. So what changed? The answer isn't just about competition. It's not just about bad luck or timing. It's about something much more fundamental, something that slowly pushed customers away without them even realizing it. By the time Kmart merged with Sears, many people assumed the worst was already behind them. It wasn't. In fact, What came next revealed just how deep the problems really were. Let's move past the nostalgia for a moment. The blue lights, the crowded aisles, the familiar announcements, and look at something far less exciting, but far more revealing: the numbers. Because numbers don't care about brand history. They don't care about memories. They tell you exactly what's happening beneath the surface. And in Kmart's case, the story they tell is brutal. Starting in the mid-2000s, one trend becomes impossible to ignore. The number of stores begins to shrink. Not slowly, not occasionally, consistently. Year after year, locations were being shut down. Now you might think, well, fewer stores could just mean the company is becoming more efficient. And sometimes that's true. Companies close underperforming locations all the time to focus on stronger ones. But here's the problem. Kmart's revenue didn't stabilize after those closures. It kept falling. That's the key detail. Because if fewer stores were making more money each, you'd expect revenue to level out, or even grow. But that didn't happen. Instead, total revenue dropped year after year, eventually falling to less than half of what it once was. That tells us something important. It wasn't just the number of stores shrinking. Each individual store was also performing worse. Think about that for a second. Fewer stores, less money per store, declining revenue across the board. That's not a temporary issue. That's a system-wide breakdown. And it gets worse. If you compare Kmart's performance to competitors like Walmart and Target, the gap becomes even more obvious. While Kmart was shrinking, those companies were expanding. While Kmart's sales were dropping, theirs were growing. They weren't just surviving, they were accelerating. So what exactly was going wrong inside Kmart? To answer that, we need to look at something called the debt-to-equity ratio. Now, don't worry. This isn't as complicated as it sounds. Imagine a company as a person. Debt is what they owe. Equity is what they actually own after paying off everything they owe. The ratio simply compares the two. A healthy company usually keeps this number relatively low. It means they're not over-relying on borrowed money. But Kmart? That number started climbing. And not just a little. At first, it stayed within a reasonable range, but then, over a few short years, it spiked dramatically, rising to levels that would make most lenders extremely uncomfortable. Then, something even more alarming happened. The number didn't just get high. It went negative. That's not just bad. It's a red flag of the highest order. Negative equity means that if the company sold everything it owned, it still wouldn't have enough money to pay off its debts. Let that sink in. If Kmart had shut down completely at that point, it wouldn't just walk away with nothing. It would still owe money. Now imagine you're a bank. Would you lend money to a company that can't even cover its existing obligations? Probably not. And that's exactly the situation Kmart found itself in. Access to funding became more difficult. Investment dried up. Options became limited. It's like being stuck in quicksand. The more you struggle, the deeper you sink. And the financial trouble didn't stop there. Take net income, the simplest measure of whether a company is making or losing money. For Kmart, that number turned negative and stayed there. Year after year, losses piled up. Now, when people hear that a company had another year of losses, it can sound abstract, like just another headline. But in reality, consistent losses are one of the clearest signs that a business is heading toward collapse. You can survive a bad year. You can even survive a few. But you can't survive a decade of decline. At some point, something has to give. And here's what makes it even more striking. Kmart itself acknowledged the problem. In official filings, the company openly stated that there was substantial doubt about its ability to continue operating. That's not speculation. That's not analysis. That's the company admitting in its own words, that its future was uncertain. So by this point, the situation is clear. Stores are closing, revenue is falling, debt is rising, losses are stacking up. Everything is pointing in one direction. But here's the real question. Why? Why were customers no longer spending money there? Why were stores underperforming? Why were competitors pulling ahead so aggressively? Because numbers can tell you what is happening, but they don't tell you why. Up to this point, everything we've looked at, the falling revenue, the store closures, the rising debt, those are all symptoms. They tell us something is wrong. But now we're getting to the cause. Because businesses don't fail just because of numbers. They fail when people stop choosing them. And that's exactly what happened to Kmart. There wasn't a single moment where everything collapsed overnight. No dramatic turning point. No sudden scandal that drove customers away. Instead, it was something much more subtle and much more dangerous. People just stopped going. Think about your own habits for a second. If you need groceries, where do you go? Probably somewhere convenient, clean, and predictable. If you're buying something bigger, electronics, home goods, appliances, you likely choose a store that feels modern, reliable, and easy to navigate. Now compare that to what many Kmart locations had become. Walking into a Kmart in its later years often felt like stepping into a different time, not in a nostalgic way, but in a way that made you question whether the store had kept up with the world outside. The layout felt outdated. The lighting felt dim. Shelves were often disorganized. And instead of feeling like a place you wanted to spend time in, it felt like a place you wanted to leave as quickly as possible. That experience matters more than most companies realize. Because today, customers don't just shop for products. They shop for convenience, for comfort, for speed. And this is where competitors like Walmart and Target made a critical move that Kmart didn't. They evolved. Walmart doubled down on efficiency, low prices, massive inventory, and constant expansion. Target focused on presentation, clean stores, better design, and a more enjoyable shopping experience. Two different strategies, both effective. Kmart, on the other hand, got stuck in between. It wasn't the cheapest. It wasn't the nicest. It wasn't the fastest. So customers had no clear reason to choose it. And when a business loses its identity, it loses its customers. But the problems didn't stop at appearances. Let's talk about something even more frustrating: time. Imagine you're standing in line at a store. You've already spent time walking through the aisles, finding what you need, maybe dealing with clutter or confusion along the way. Now all you want is a quick checkout. But the line isn't moving. The registers are slow. The system feels outdated. The process takes longer than it should. That small inconvenience, it adds up. Because customers remember how a place makes them feel. And if every visit feels just a little bit frustrating, just a little bit slower, just a little bit worse than the alternatives, eventually, they stop coming back. It's not anger that drives them away. It's indifference. And indifference is far more dangerous. There's also another factor that often gets overlooked: people. Retail is a human business. The employees, the service, the interaction, that all shapes the experience. Now, this isn't about blaming individuals, but when a company is struggling financially, it becomes harder to attract and retain top talent. And that creates a ripple effect. Stronger employees choose stronger companies, which leaves struggling companies with fewer resources to improve. And that cycle continues. It's not the starting point of the problem, but it definitely makes it worse. At every level, from the sales floor to upper management, the pressure builds. Decisions become reactive instead of strategic. Short-term survival starts replacing long-term vision. And slowly the company begins to drift. Now here's the most important question of all. What did Kmart actually offer its customers? Seriously, think about it. Was it the lowest prices? Not really. Was it the best shopping experience? Definitely not. Was it the fastest or most convenient option? Again, no. So why would someone choose it? That's the question Kmart never answered. And while it struggled to figure that out, something else was happening. Something that was changing the entire retail landscape. The rise of online shopping. Suddenly, customers didn't even need to go to a store anymore. They could browse, compare, and purchase products from home. And while this shift affected every retailer, the strongest adapted. The weakest didn't. Kmart wasn't ready for that shift. It was already losing customers in physical stores. Now it was competing in a digital space it hadn't fully embraced. And that was the tipping point. Because once customers find better options, whether it's a cleaner store, a faster checkout, or the convenience of online shopping, they don't come back out of loyalty. They move on. Quietly. Permanently. By now, the pattern is clear. The declining sales, the store closures, the financial struggles, the empty aisles, none of it happened by accident. And none of it happened overnight. The fall of Kmart was slow, gradual, and, most importantly, predictable. Because at its core, this isn't just a story about a retail chain losing money. It's a story about a company losing its connection with the people it was built to serve. Let's go back for a moment. There was a time when Kmart understood its customers better than almost anyone else. Affordable prices, accessible locations, creative promotions like the Blue Light Special. It knew how to attract attention and how to keep it. But somewhere along the way, that focus shifted. Instead of asking, what do our customers need? The company began making decisions that didn't clearly answer that question. Investments were made, but not always in the areas that improved the shopping experience. Stores expanded, but didn't evolve. Competitors adapted, but Kmart stayed familiar. And in business, familiar can quietly turn into outdated. Now compare that to what was happening around them. Walmart was refining its identity with laser focus, low prices, massive scale, relentless efficiency. Target carved out a different path, style, presentation, and a more enjoyable in-store experience. Even specialized retailers like Best Buy and Home Depot made themselves the obvious choice for specific needs. Each of these companies answered a simple question. Why should a customer choose us? Kmart never found a strong answer. And without that answer, every weakness becomes more visible. If your prices aren't the lowest, customers notice. If your stores feel outdated, customers notice. If your service is slower, customers notice. And when they notice all of it at once, they leave. Not dramatically, not loudly, just consistently. One trip becomes 2 months. 2 months become a year. And eventually, the habit is gone. That's the part that makes Kmart's story so powerful and so unsettling. Because it didn't lose customers in a single moment. It lost them one decision at a time. Now let's talk about something even deeper. There's a line that appeared in one of Kmart's own corporate statements. It talked about success depending on 3 things: convenience, quality products, and strong customer service. On paper, that sounds exactly right. In reality, those are the areas where Kmart struggled the most. Convenience, slower checkouts, disorganized layouts, product quality and assortment, nothing that clearly stood out. Customer service, inconsistent at best. It's not that the company didn't know what mattered. It's that it couldn't execute on it. And in business, execution is everything. Because customers don't respond to intentions. They respond to experiences. Now here's where the story becomes more than just history. Because what happened to Kmart isn't unique. It's a pattern. A company finds success. It grows. It expands. And then, slowly it stops adapting. At first, the changes in the market seem small. A competitor improves their stores. Another lowers prices. A new technology emerges. Individually, none of these feel like a threat. But, together, they reshape the entire landscape. And companies that don't adjust, no matter how big they once were, get left behind. That's exactly what happened here. By the time Kmart tried to stabilize through its merger with Sears, the momentum was already gone. It wasn't a fresh start. It was a last attempt. And while the company continued to operate, continued to keep some stores open, the reality had already set in. The brand that once dominated American retail was now holding on, rather than leading. So what's the takeaway? It's simple, but not easy. No business is too big to fail. No brand is too familiar to be replaced. And no amount of past success can protect a company that stops evolving. At the end of the day, every business depends on one thing: the customer. Not the logo, not the history, not the size. The customer. And the moment a company stops prioritizing that, truly prioritizing it, is the moment it begins to decline. Kmart didn't disappear because of one bad decision. It disappeared because of hundreds of small ones. Decisions that slowly made customers feel like they had better options. And once people believe that, they don't come back. That's not just Kmart's story. That's a lesson for every business and every brand that exists today.